let's talk about computing flexible budget variances. There are two issues that make this material tricky. One issue is that there's no standardized way for the information to be presented. That is, the values that are given and the values that you need to compute may differ from one problem to the next. That being said, doing a homework problem or a test question is still easier than real life, because at least you know that all of the information is available, even if it's not in a form that you are expecting. You don't get that guarantee in real life. The other issue is that there are several alternative formulas for computing flexible budget variances. Mathematically, they are all equivalent, and you can pick the set of formulas that you feel most comfortable with. The ones that I'm going to show you work very well, even if they differ from the ones in the book, and I find that they're a little easier to remember and a little easier to compute, but you use the ones that you like best. Let's take a look first at direct labor variances. We have some production information for XYZ Manufacturing. We were told that they expected to produce 10,000 units, but actually produced only 9,800 units. We're also given some information specifically about direct labor. We're told their quantity standard, how much direct labor they expect to use per unit, and their price standard, how much they expect to pay their workers per direct labor hour. We are also told the actual amount of labor used and how much it cost. Our job is to compute the direct labor variances. The first thing that we can do is compute the total flexible budget variance for direct labor. That is, the difference between what we actually paid for our direct labor during the period and what we would have budgeted on the flexible budget for the actual number of units that we produced. The formula for actual cost is actual quantity times actual price. But in this case, there's no need to compute that because the total cost for labor was given to us. Now we have to figure out what would be the standard cost on the flexible budget. The standard quantity for labor at the actual level of activity would be the 9,800 units that we made times the amount of labor that we budgeted for each unit, a quarter of an hour each. And then to determine the total standard cost, we would multiply that by $10 per labor hour. We can figure that amount out, and then all we have to do is compare what we actually paid to what we would have budgeted on the flexible budget for the actual amount that we made. The difference is $196 unfavorable. Now we need to disaggregate that variance, break it down into its components in order to understand why this happened. One component is the direct labor price variance. That is the difference between the actual price we paid and the price that we expected to pay for the actual quantity of labor that we used. This variance is usually called a price variance. It's sometimes called a rate variance. Let's see if we have the information to solve this. We were told the actual number of labor hours that we used, but we need to figure out the actual price that we paid. We have enough information to do that. We know how much we paid in total. We know how many labor hours we used, so we can divide the actual number of labor hours into the total number of dollars we paid for labor, and that tells us that we paid on average $9.80 per labor hour. Our standard price for labor was given to us, $10 per hour. Now we can plug that information back into our formula, which now says how much dollar difference did it make to our labor cost that we paid $9.80 per labor hour instead of the $10 that we expected to pay, given the number of labor hours that we used. And we can crank out that answer. Since we paid less per labor hour than we expected, that's a favorable variance. Now we can also compute the direct labor efficiency variance. This is also sometimes called a usage variance, or it's sometimes called a quantity variance. They mean the same thing. And that is the difference in the quantity used, but at the standard price. Here's the reason for that formula. We've already dealt with the effect of paying a different amount than we expected to. Now, what we're saying in our efficiency variance is, let's suppose there were no price variance. Let's suppose that we actually paid the standard price. In that circumstance, how much dollar difference did it make that we used a different amount of labor than we expected? So let's see if we have enough information to complete this formula. We were given the actual quantity of labor used, but not the standard quantity. However, we have enough information to figure it out. For 9,800 units, if we expect to use a quarter of a labor hour per unit, that tells us that our flexible budget standard at the actual level of activity would be 2,450 labor hours. So we can figure out the difference in quantity. We're going to multiply that difference by the standard price, which we were given, $10 per labor hour. When we crank that out, we find that we have a $700 unfavorable direct labor efficiency variance. That is, ignoring any variance in price, the fact that we used more labor hours than we expected cost us an additional $700. So, we can take the price variance and the efficiency variance and add them together, and they must exactly equal the total direct labor flexible budget variance, because all costs have to go somewhere. So that total flexible budget variance has been completely explained by the effect of paying a different amount than we expected, plus the effect of using a different amount than we expected. Now we have to think, what caused the favorable price variance? Well, clearly it means we paid our workers less than we expected to. But why did that happen? There are several possibilities, and as a manager, you would have to investigate to find out which possibility was in fact the cause. It could be that our workers expected a pay increase, and we had budgeted a pay increase that in fact did not actually happen. In that case, we ended up paying less for our work than we had thought we were going to. Alternatively, it may be a matter of who actually did the work. If we expected to use somebody with more skill and a higher hourly rate, but in fact used someone with less skill and a lower hourly rate, that could also cause the price difference. Either way, we definitely paid less for work than we expected. What about the efficiency variance? That always comes from using more labor hours than we expected. And that happened in this case. We used 70 more labor hours than we had budgeted. Now the question is, why did that happen? One possibility is that the machines broke down, and because of that, it took our workers longer. The managerial implications of machine breakdowns is we need to get the machines fixed because it's costing us money when they don't work properly. However, another possibility that we should consider is whether the unfavorable efficiency variance is actually related to the favorable price variance. For example, if our workers expected a 20-cent an hour wage increase and that didn't happen, they may be disappointed. Disappointed workers don't always work at peak efficiency. If that is the case here, we might want to consider giving them the 20 cents per hour wage increase because it is actually costing us more in slowdowns than it is saving us in wages. Another possibility is that the favorable price variance came from using someone with less skill. Yes, it saved us some money, but a person with less skill might take longer to do the work. Again, we might want to consider going forward choosing someone with the appropriate skill level. Now we have to journalize these variances. In a standard costing system, variances are actually part of our journal entries and accumulate throughout the period. You don't see them on external financial statements because they close to cost of goods sold at the end of the period. So for now, go from what you know to what you don't know. We know for sure that we owe our workers $24,696. That was given. But we are going to add labor to our work in process at standard. That would be the standard quantity times the standard price for the actual number of units that we made. Now, the difference between the actual amount and the standard amount can be recognized by our variances. Therefore, we're going to debit the unfavorable direct labor efficiency variance that represents an increase in our costs, and we are going to credit the favorable direct labor price variance. Of course, we know that the sum of the debits must equal the sum of the credits, and we can use that to check our work. Now let's look at direct materials flexible budget variances. We're given information about the standards for quantity and for price at XYZ, and we're given information about the actual amount of material purchased and the actual amount of material used. Let's use that information to compute our flexible budget variances for direct materials. Let's use that information to compute our flexible budget variances for direct materials. We know that the difference between the actual cost and the standard cost at the actual level of activity gives us our total direct materials flexible budget variance. And we could compute that for materials just the way we did for labor if the amount of material that we purchased was exactly equal to the amount of material that we used. In this case, that's not so. That means that the actual quantity that we used is different from the actual quantity that we purchased, and because of that, there is no total flexible budget variance for materials. That being said, we can still compute a price variance and an efficiency variance, just remembering that when we say quantity, it's the quantity purchased when we're computing the price variance, but it's the quantity used when we are computing the efficiency variance. So for the price variance, we know how many pounds of material we bought, that was given, and we know that we actually paid $3.10 per pound, whereas our standard was $3 a pound. So how much dollar difference did it make that we paid an extra 10 cents per pound? Multiply 10 cents a pound times the actual number of pounds that we bought to get the answer, and it's unfavorable because we paid more than we expected. To compute the direct materials efficiency variance, we're going to use the standard price. In other words, we're saying, let's assume there was no price variance. In that case, how much dollar difference did it make to us that we used a different amount than we expected? For the direct materials efficiency variance, we're going to compare the difference in the amount of materials that we would expect to use for the number of units we actually made versus the amount of material that we actually used. But we're going to multiply that times the standard price. Remember, we're going to use standard price because we already considered the direct materials price variance. So here we are saying, let's assume that there was no price variance. How much dollar difference did that difference in usage make? So let's see what kind of information we have. We know the actual quantity of materials used, that was given. Now we have to figure out what was the standard quantity for the number of units that we actually made. That would be 9,800 units times $2 per pound. We can now compare the actual quantity to the standard quantity and then multiply it times the $3 per pound standard price. When we do, we find that we have a $600 favorable efficiency variance for materials. That means because we use 200 pounds less than we expected at a standard price of $3 per pound, that saved our firm $600. Now, what caused the unfavorable price variance? Could be a number of things. Maybe we didn't negotiate well with our suppliers. Alternatively, perhaps we didn't take advantage of the discount for early payment. However, another possibility is that we got higher quality materials. This is also suggested by the fact that we have a favorable efficiency variance. We used less materials than we expected. So it is possible that these two variances are related. On the other hand, maybe that wasn't such a good idea because it cost us a lot more to pay for higher priced materials than we saved by using less materials. To record direct materials variances, we need to record the purchase separate from the use of these materials. Go from what you know to what you don't know. We know for sure how much we owe our suppliers for the material that we actually bought. That information was given. But we're going to put that material into our materials inventory at the actual quantity that we bought, but the standard price. The difference between these two is that unfavorable materials price variance. To record the use of the materials, we're going to take the materials out of our materials inventory the same way that we put it in, at the actual quantity, this time the quantity that we use, but at the standard price. But we're going to put it into work in process at the standard quantity and the standard price. The difference between these two is our favorable direct materials efficiency variance. Let's do a practice problem. We have some information about ABC Manufacturing. We know how many units they expected to produce versus how many they actually produced. We're given information about their expectations and their actual use of materials, and their expectations and their actual use of labor. What I'd like you to do is compute the direct materials price variance, the direct materials efficiency variance, and the total flexible budget cost variance for direct materials. The formula for the direct materials price variance is the actual quantity times the difference in price between what we expected to pay and what we actually paid. In this case, we were told the actual quantity of materials that was used, and we were also told the budgeted and actual price. We expected to pay $30 a pound. We actually paid $29 a pound for the amount of materials that we bought. That means that we saved $62,300. The formula for the direct materials efficiency variance is the difference between the amount of materials that we thought we would use and the amount that we actually used, but at the standard price. In this case, we know how much material we actually used. We have to figure out how much material would be budgeted for the 20,000 units that we actually made. Then we take that difference between what we actually used and what we thought we would use and multiply it by the standard price, $30 per pound. So if we actually used 62,300 pounds, but we expected to use only 60,000 pounds, at a standard price of $30 per pound, that tells us that we spent an additional $69,000. The total flexible budget variance for materials can be figured out in two ways. One way is to find the difference between what we actually paid and what we would have expected to pay. We know how much we actually paid, that was given. How much would we expect to pay for 20,000 units? At 3 pounds per unit, at $30 per pound, we can figure out that we would have expected to pay $1,800,000. In fact, our actual cost for the materials was a little bit more than that, giving us an unfavorable total flexible budget variance for materials. Alternatively, if we wanted, we could compare the price variance for materials to the efficiency variance for materials, and that would give us the exact same answer. Now, what are these variances telling us? Here we see that we have a significant favorable price variance. We paid a lot less for materials than we budgeted. On the other hand, we used a lot more materials than we expected. In fact, the additional cost from using more far outweighed the cost saving from paying $29 a pound instead of $30 a pound. It may be that the price simply went down and the quality went down even more. Alternatively, it may mean that our purchasing department did not shop well. In their efforts to save $1 per pound on the materials, they ended up forcing the production department to use significantly more materials because the quality was substandard. Now let's take a look at the direct labor variances for the same firm. I want you to compute the flexible budget price variance for labor, the efficiency variance for labor, and the total cost variance for labor. Let's take a look at the solutions. The formula for price variance is the actual amount of labor that we used times the difference in price between what we expected to pay and what we actually paid. Here we're given the actual quantity for labor, and we're also given the standard and actual price per labor hour. And you can see very easily we must have paid an extra $1.50 per labor hour. So given the number of labor hours that we used, It ended up costing us an additional $77,250 for labor compared to what we would have budgeted for the number of units that we made. What about the efficiency variance? The formula is the difference in quantity between how much we expected to use and how much we actually used, but at the standard price. So, how much difference is there in quantity? We know the actual quantity because it was given to us, but we need to compute the standard quantity. If it takes 2.5 labor hours per unit, we would multiply that by the actual number of units that we made to get the standard quantity. Then we can multiply that difference by our standard price, $20 per labor hour. When we crank that out, we find that we used an additional 1,500 labor hours. At $20 per hour, that means it cost us an additional $30,000 because we used a little bit more labor than we expected. Altogether, we can figure out our total cost variance in two ways. One way is to compare the actual cost for labor to the standard cost at this level of activity. In that case, we know the total labor cost. We can figure out the standard cost, 2.5 labor hours per unit times 20,000 units times the $20 standard cost. That works out to an unfavorable variance of little over $107,000. So what's this telling us? It says that we paid more per labor hour than we expected, and it tells us that we used more labor hours than we expected. And then we can think about why that happened. One possibility that we might consider is the fact that our unfavorable labor efficiency variance is related to the quality of our materials. Alternatively, you can combine the unfavorable price variance and the unfavorable efficiency variance, and it should take you to exactly the same place. How do we understand these results? One possibility that we haven't considered before is that unfavorable direct materials efficiency variance that we just found in the previous part of this problem. Production seemed to use a lot more material than was budgeted, and we considered the possibility that the firm had saved a little bit per pound and bought substandard material. That may relate to the unfavorable efficiency variance that we see for labor. If the firm bought substandard materials, it's possible that it took workers longer to produce our product because the material was not up to their standards.